Hello everyone. In this video, we're going to be going through the topic of repurchase agreements. This is a relatively quick topic within the revenue recognition overall topic. So let's just go ahead and jump in. What is a repurchase agreement? It's an arrangement between two companies in which one company sells another company a product and agrees to buy it back later. So basically company A says to company B, I'm going to sell you a product, I'm going to buy it back later. Okay. Generally, it's reported as a financing transaction. As long as the repurchase price is equal to or greater than the original selling price, GAAP requires us to treat the repurchase as a financing transaction. Okay, why do companies do this? Seems really weird. They do it a lot of times for tax advantages and there are other reasons, but the main reason is for if they need financing, right? That's one reason, but the other one is also for tax advantages. Okay, but basically all we really need to know for this topic is what's on these two pages. Just a quick definition of it. Okay, they sell it and then they buy it back. And then a problem like this, if you knew how to work something like this, you should basically be good to go. Okay, so on January 1st of 2017, Jim Company sells a piece of equipment to Dan Company for $400,000. Jim agrees to repurchase the equipment on December 31 of 2018, so that would be 2 years later for $501,760. The appropriate interest rate is 12% for this transaction. Required to prepare the journal entries for Jim Company for the following dates: January 1st, 2017, December 31st, 2017, December 31st, 2018. Okay, so we're just going to go through this relatively quickly. Nothing too crazy here. Okay, the first thing we do is that on January 1st, we're going to receive cash for $400,000, and then we're going to have a liability to Dan Company for $400,000. This is a financing transaction, right? So that means that we're receiving cash in exchange for, we're going to have to record a liability, right? Because we're going to have to pay Dan money in the future, right? So Dan is giving us $400,000. We owe Dan money in the future, so we say liability to Dan Company. Okay, then what you're going to see is that as this goes on, what we're going to do is at December 31 of 2017, we're going to record interest expense, okay? The way we're going to record interest expense is we're going to take the carrying value of the liability, multiply it by the appropriate interest rate, which is 12%. That gives us $48,000 of interest expense, okay? So we do interest expense for $48,000, and what we do is we increase the liability to Dan Company by $48,000. Because what we're going to do is that we're going to grow this liability. We're going to increase the carrying value of the liability each year until we have to actually pay out the $501,760. Because what's going to happen is that we're going to grow this liability. We're going to increase its carrying value from $400,000 to $501,000 within 2 years. Okay, so the way that we do that is we record interest expense. Okay, so again, the first transaction, you just put the liability on the books, you record the cash. Next, at the end of that year, you want to record a full year of interest expense because the liability is outstanding for the entire year. Okay, so you just debit interest expense for $48,000, credit the liability to Dan Company, $48,000. Again, we just took the interest rate and multiplied by the carrying value. Then for the next year, it says due December 31 of 2018, that's our last year. Interest expense is going to be $448. How do we get $448 times 0.12? How do we get $448? Well, it'd be $400,000 initially plus $48,000. That's going to increase our carrying value, right? By crediting this liability, we're increasing our carrying value, which means that we're going to have compound interest, basically, right? Our interest expense is going to be higher in the second year. It's going to be $53,760. Okay, so again, we make the same journal entry: debit interest expense, credit liability to Dan Company. We make that entry first. Then we have to pay back Dan, right? We have to buy this piece of equipment back. So what we're going to do is we're going to debit liability to Dan Company for $501, credit cash for $501. Okay, because what happened is that we record this liability, we got the cash. Then we increase the liability's carrying value 2 times to $501,000, right? If we add $400,000 plus 48 plus $53,760, we'll get to $501,760. Then we just remove the liability. We pay back Dan. Okay, we buy back the equipment. So that is shown as removing the liability at the full value of $501,760 and paying out cash. Okay, so that's basically the extent of these transactions. As we can see, it's nothing too complicated. We just basically need to know what's on this first page from a definitional, conceptual standpoint, and then if we could do something like this, that's basically what we would need to do for a quiz or an exam. Okay, so that's the end of this video, and I hope that was helpful.